everyone. Welcome to Russell Investments Market Week in Review for the week ending February 21st, 2025. My name is Bei-Chin Lin. I'm a senior investment strategist and head of Canadian strategy here at Russell Investments. On this week's edition of Market Week in Review, we're going to be discussing three factors. First, we're going to talk a little bit about the Reserve Bank of Australia's decision. Next, we're going to discuss the latest Canadian inflation data. And finally, we'll wrap up with a look at Chinese equities and what investors need to keep in mind. So let's begin with the RBA. Earlier this week, the Reserve Bank of Australia decided to lower interest rates by 25 basis points. This marks their first interest rate cut for the cycle. And although the Reserve Bank of Australia was a little bit later than the other G7 central banks in terms of when they started their rate cutting process, we expect that as inflation continues to generally moderate over time, the Reserve Bank of Australia should be able to gradually take interest rates to a more neutral setting. We also got two additional data points on the Australian labor market that were released after the RBA's decision. First, on the wage pressure side, wage pressures came in a little bit softer than expected, and that's a positive development in terms of suggesting that over time, inflation should be able to continue to moderate in Australia. Second, the latest Australian unemployment data showed that the unemployment rate rose slightly, but still generally in line with consensus expectations. And so it suggests that the Australian labor market is gradually softening a little bit, but nothing to be too alarmed about at this point in time. So that would be supportive of the RBA's decision to begin a gradual rate cutting process. The second topic I want to discuss is the latest Canadian inflation data. And we got data on both the consumer side and producer side of the equation, and both pieces came in somewhat hotter than consensus expectations. But I think it's important to keep the inflation data in the broader context of where the BOC is on its inflation fight. If we think about the BOC's preferred measure of core inflation, it's at 2.5%, which is already within the 1 to 3% target band and significantly down from the peak. In addition, when we look at the old measure of core inflation that the BOC used to use, that measure is now at 2.1%, which is basically more or less 2%. And so I think the BOC is going to be a little bit more tolerant of a temporary setback in inflation than it would have been if inflation were higher. And as long as inflation, generally speaking, over time continues to moderate, then I think the Bank of Canada can continue the process of bringing interest rates eventually all the way down to around 2.75% in a neutral setting. Now, of course, in Canada, the risk of an economic slowdown is a little bit more elevated than the risk in the US. And if the Canadian economy were to tip into a recession, then you could see the Bank of Canada cut rates even more meaningfully. And even if the Canadian economy doesn't tip into a recession, based on the labor market dynamics and based on the economic growth on a per capita basis being weaker than in the US, I do think that you could see the Bank of Canada even take rates somewhat below that 2.75 neutral rate later this year, just to give a little bit more support to the Canadian economy. But of course, they're going to be data dependent. And in terms of the next March decision, markets right now are pricing in less than a 50% probability of a rate cut, but I am a little bit more open-minded. I think it's quite possible that the Bank of Canada still has to cut rates, and it's all going to depend on what the next labor market will likely show us, as well as other key economic data points for Canada that we're going to get in the months to come. Finally, in terms of Chinese equities have had a pretty strong month so far. Part of this is probably due to investor expectations around the potential for more stimulus. As my colleague Alex Kusley wrote in an article recently, China is going to be holding a major policy session later in March, and at that session, they're likely to announce their GDP growth target for the year. If they announce a target of around 4.5% to 5%, it means that they're probably going to have to do more stimulus. Now, because of the pace at which Chinese equities have run up in the recent month, it does mean that Chinese equities have become somewhat overbought relative to the broad equity market. That being said, Chinese equity valuations still look quite reasonable to us and are more attractive than equity market valuations in the US. And so we continue to think having that diversified portfolio exposure, including an allocation to China, can be an important step for investors. We think it's important to stick close to that strategic asset allocation. Thanks for tuning in.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.